Hello, everybody. Welcome to Clever Investments. Today, let's talk about hedge fund. So, what is hedge fund? Most people know about mutual fund, where the fund pool people's money and buy stocks or other properties such as bonds. But for hedge fund, they are more actively managed and they can use any trading method, such as using options, futures, shorting stocks, and so on. So the hope is they can profit from the market under any market conditions. If the market stays flat, they can use up some option strategies to profit from it. If the market goes down, they can short the stock or buy puts to profit from it. And the expectation is hedge fund can make more money than the regular mutual fund or index fund. It has very high management fee because people are actively managing it. And a common fee structure is that every year it takes 2% of fixed fee out of your portfolio. Basically, that means if you invest $100 every year, they will deduct $2. And that's much higher than regular mutual fund, which is on the order of 0.5% or less. And also, they take 20% of the profit after the account is higher than the previous maximum. So this is called the high watermark rule. So for example, if you have an account and it grows to $200 before, and then later it drops back to 150. And next year, if it grew from 150 to 190, it made $40, but the fund cannot take 20% of the profit because the previous high was $200. So only after the fund is more than $200, such as $210, then that extra $10 is profit and they can charge 20% of that profit. So overall, this is a very high management fee. And also hedge fund is often not very liquid compared to mutual fund or index ETF. This is because there's not enough people invested in each individual hedge fund and investments they're doing could be not very liquid, such as they invest in real estate and it's not easy to get money out. So there are more limitations on hedge fund than mutual fund or ETF. And they also often charge a very high initial investment. So for example, 100K is a common number. If you invest in a certain hedge fund, very often you need to invest 100K or more. And some funds even demand a higher minimum investment, such as millions. And also hedge fund may not be open to everybody. So some funds, they are good, they are successful, but they closed new investments from many average people. This is often because the market they're looking at might be small and they cannot use too much capital to exploit that opportunity. So they often limit the size of the hedge fund so that the overall return looks good. Hedge fund charges a high management fee. If they give you a very high return, this fee can be justified. Because after all, only after they make good profit, they charge the 20% of the profit as a part of the floating fee. But this high watermark rule could be worked around. So for example, some hedge fund company, they could close out a money losing hedge fund and open a new one. Because when you open a new hedge fund, you reset the high watermark. And if you keep closing the losing hedge fund and keep opening the new ones, and whenever the fund grows and makes some profit, the fund manager can take a hefty fee, 20% of the profit as their management fee. And most importantly, most of the hedge fund cannot beat the simplest index fund of S&P 500. After they charge all those fees and actively manage all of them, they cannot beat S&P 500. I think this is because For any fund trying to beat S&P 500, they are playing a zero-sum game. For any return that's higher than S&P 500, they are playing the zero-sum game against other hedge fund or mutual fund. So a zero-sum game is something I would avoid because what you make is what somebody else lose, and you can only make some money if you're the best of the best, which is very, very rare. And only a few percentage of the hedge fund manager can beat S&P 500. It's too difficult to find them. So I would highly recommend you just stick with S&P 500 or Nasdaq 100 index. As an example of the performance of hedge fund, Warren Buffett once criticized the high fee of hedge fund, said they do not justify charging such a high fee because they cannot beat S&P 500. And Warren Buffett actually placed a $1 million bet against hedge fund. He said, if somebody can pick a hedge fund and beat S&P 500 in 10 years, Warren Buffett would donate $1 million to some charity. Or if the hedge fund loses to the S&P 500, the hedge fund would donate $1 million. And somebody took up the bet and bet against Warren Buffett. You know who won the bet? Okay, let's look at the number. So if you look at the red bar, somebody picked a fund of fund. And in that fund of fund, you are free to change hedge fund. It invests in 5 other hedge funds, and it is free to change the hedge fund at any time. Of course, they charge an extra fee to do that. And after 10 years, the fund of fund has made 22%, and the index fund made 85%. So we know that on average, the stock market doubles every 10 years. So 85% is almost double. That's not bad. But if you look at all the other 5 hedge funds selected, none of them can beat index fund. And their average is a very poor 22% return in 10 years. So it's a terrible performance. And for me, I believe it's not worth to try to find a good hedge fund to invest. Buying an index fund is much easier and a better method for us to invest. Okay, that's all for today. Thank you.